The most dangerous feeling in investing is not always fear. Sometimes it is excitement. Excitement makes you open the app more often. It makes charts feel alive. It makes headlines feel urgent. It makes other people's profits feel like a personal warning. It makes waiting feel irresponsible, even when waiting is exactly what your plan requires. For ordinary investors, this is where many mistakes begin. Not because people are stupid, not because they do not care about the future, but because investing is one of the few areas where doing more makes the result worse. This feels unnatural. In school, more effort helps. At work, more attention improves performance. In fitness, consistent action matters, so people bring the same instinct to investing. If I pay more attention, react faster, and search harder, I should do better. But markets do not reward attention in that simple way. Sometimes, more attention only gives your emotions more chances to interfere. This is why boring investors often beat excited investors. Boring does not mean careless, uninformed, or ignoring risk. Boring means the strategy is simple enough to repeat when the world becomes noisy. The hidden mechanism is error reduction. An excited investor usually creates more decision points. Should I buy, sell, switch, chase, avoid, add, wait, or listen to an expert? Every decision point is an opportunity to be right, but also to be wrong. And when decisions are made under excitement, the mistakes often have a pattern. You buy after a rise because the story feels proven. You sell after a fall because the pain feels informative. You switch strategies because someone else's result looks better. You confuse a good story with a good price. You confuse activity with control. A boring investor tries to reduce the number of emotional doors. They decide in advance what they own, why, and when they will review the plan. They do not need every headline to become a personal instruction. Think of investing like driving through fog. The excited driver keeps changing lanes because every shadow looks like a shortcut. The boring driver slows down, keeps distance, and avoids sudden moves. The boring driver may not look impressive, but they are less likely to crash. In investing, avoiding crashes matters more than looking clever. The common mistake is believing that excitement equals opportunity. Sometimes it does, but often, excitement is just social proof arriving late. By the time everyone is talking, the emotional price has already changed. You are not only evaluating an investment, you are evaluating your fear of missing out. This is especially difficult because excitement feels productive. Reading more posts, watching more predictions, checking prices feels productive. But if none of that changes your plan in a disciplined way, it may only be feeding the part of your brain that wants action. The better mental model is a quiet machine. A good investing process should not require constant emotional fuel. It should be able to run on ordinary days with automatic contributions, clear allocation, periodic review, and risk limits. You need a written reason for each major decision and enough humility to know that no one can predict every turn. This kind of system is not exciting. That is the point. It protects you from needing to feel smart every week. For many, the biggest advantage is not finding the perfect opportunity. It is staying away from unnecessary damage, avoiding panic selling, avoiding hype buying, and avoiding concentration you do not understand, avoiding fees and taxes created by constant movement, avoiding the emotional exhaustion that makes people abandon a reasonable plan at the worst moment. This does not mean everyone should invest the same way. It does not mean risk disappears or that boring always wins in every period. But it does mean that a repeatable process has value, especially for people who are not trying to make investing their full-time job. The practical takeaway is to separate research from reaction. Research can be scheduled, but reaction is usually triggered. If you only think about your investments when a headline scares you, the market is choosing your timing. Instead, create review windows, maybe monthly or quarterly. During that time, look at your plan, your risk, your contributions, your goals, and whether anything meaningful has changed. Outside that window, remind yourself that not every price movement is a message for you. Another useful rule is to write down the reason before making a major move. Not a vague reason, like this looks promising, or things feel bad. What changed? Is it connected to your plan? Are you reacting to price, story, fear, boredom, or actual new information? Writing slows excitement down, and in investing, slowing down can be a feature. The quiet investor is not trying to win every conversation. They are trying to keep their future intact. They understand that wealth often grows in periods that feel almost embarrassingly uneventful. Contributions happen, time passes, and markets move. The plan is reviewed, not constantly reinvented. The world will always offer a louder story. There will always be a chart that looks urgent, a prediction that sounds confident, and a crowd that seems to know something. But your capital does not need noise to be serious. Sometimes the most powerful investment behavior is the one that gives you the least to talk about.